Hello everyone and welcome to Moementum channel. My name is Mo, and in this video we're going to be taking a look at 3 undervalued dividend stocks that are considered to be fast dividend growers with 10% dividend growth in their latest dividend increase annually. Without any further ado, let's get into it. The first company for us to take a look at is called Appb, which is a healthcare sector company. It's a biotechnology pharmaceutical firm formed in 2013. When Abbott Laboratories spun off its branded biopharma business, and as a result, Appb was formed. As you notice here, Appb does pay a dividend currently yielding at 4.79%, and it is traded on New York Stock Exchange with ticker symbol ABBV. From a dividend safety score, Appb has a score of 70, considered to be a safe dividend payer. And as we mentioned in the last dividend growth increase, it had an increase of 10% in its annual increase, and this was done in November of 2020. From a volatility perspective, Appb stock has a score of 0.67, and beta is a measure of volatility. The lower this number, that suggests that the stock is less volatile than the overall stock market. In this case, given that 0.67 is less than 1, Appb's stock is believed to be less volatile than the general stock market. Appb has a market capitalization of $192 billion, making it a mega cap company. Looking at the company's history and some of the details, since becoming an independent company, Appb has remained focused on branded drugs, an industry with high barriers to entry and excellent profitability. Major pharma players invest billions of dollars, as you may know, and years of time in research and development to commercialize breakthrough drugs. And to reduce its dependence on just a single sales and profit source, Appb has invested heavily to expand its drug pipeline and made several large acquisitions. Most noticeably, and they had the acquisition in 2019, a deal to buy diversified healthcare company Allergan for more than $80 billion. Simply put, Appb will still depend on the success of a handful of its treatments, such as Humira, but also there aren't necessarily reasons to avoid the stock, because the stock might be a little bit volatile. They're also heavily investing and kind of expanding their offerings. Looking at the key metrics when it comes to dividends for Appb, the company does have a payout ratio of 43%, which is edging a little bit high for biotech companies, but their forward payout ratio is a little bit less, which is ideal, and it's at 39%. Generally speaking, for us, we would like to see a payout ratio hovering between 25 or 20% all the way to maximum of 60%, and in this case, this for us at least, it meets our guidelines in that sense. But of course, you can be a little more specific by looking at how that payout ratio compares to that of the biotech industry. Looking at the performance during the recession of 2007 to 2009, Appb sales actually increased by 10% during that time frame, which is considered to be above average growth for that time period. Their stock actually does not have any stock price history, given the fact that the company was actually spun up at a later time than the recession. So the recession sales growth is more so around the parent company in that sense. The company has a dividend streak of 7 years, and as we talked about, in the focus of this video was around the dividend growth. We mentioned that we are looking at 3 companies with fast dividend growth, and look at that. Over the past 5 years, annually, Appb has grown its dividend by 18%, which is considered to be very fast compared to overall dividend paying companies. And in the latest round of increase of dividend, which was last November, they increased their amount of dividend annual payout by 10%, again making it a fast dividend grower at this time. Looking at the dividend history, the company actually started paying dividends 7 years ago, and ever since then, they have increased their dividend payment year after year. Looking at the payment schedule for their dividends, the company does pay its dividend on a quarterly basis, and this is paid in the months of February, May, August, and November. And currently, their annual payout is at $5.20 per share. Let us take a look at some valuation metrics. Appb's current dividend yield of 4.79% is about in line with their 5-year average of 4.74%. This suggests that the stock may be reasonably valued today. However, it's also worth mentioning that their forward price to earnings ratio, which is at 8.1 is well below their own 5-year average of 9.4, as well as well below that of the healthcare sector, which is at 19.6. In these cases, an unusually low price to earnings ratio often indicates that the company's earnings could be near a cyclical peak, or that investors believe that the firm's long-term prospects for growth have weakened. Though a very low price to earnings ratio doesn't necessarily signal a cheap stock. So that's something for us to keep in mind, which is why we are looking at a number of other financial metrics, as well as what has other analysts have to say in terms of the projections for the 1-year price target, as well as the intrinsic value from a fair valuation perspective. So we're going to take a look at all of those in a moment. Let us also take a look at the 52-week price range for Appb stock. The lowest price that the stock has hit in the past 1 year was at $80.49. The highest was at $120.78. Currently, based on at the time of making that video, the last trading price for the stock was at $108.56. As promised, we're going to take a look at a number of other financial metrics that allows us to have a better grasp of where this stock is at and how much of an undervalued or overvalued stock it is, and how it is in terms of financial metrics. The first one we're going to take a look at is one that is super important in analyzing stocks, particularly dividend stocks, which is earnings per share. Ideally, we would like to see our adjusted earnings per share kind of growing year after year, showing that the company is actually increasing their earnings power over time, being able to actually fuel their dividend growth and appreciation in their stock price. And for the most part, actually, we are seeing that. We had, of course, in 2013 and 2014 that you see the stock earnings per share had a little bit of decline. But other than that, for the most part, since 2015, we are seeing that continuous nice increase in earnings per share, which is just remarkable. The graph at the bottom, earnings per share growth, actually shows that very nicely. This just compares every 1 year to the year prior to that, and showing you how the earnings per share have increased. See, 2014 we had that 6% jump, 29%, 12%. The highest was at 2018, which had a 41% jump in earnings per share compared to the year prior. And looking at the next 12 months based on projections, we are also anticipating a 13% jump in earnings per share for Appb. Next metric that we're going to take a look at is the total number of sales or revenue for the company. And a healthy business is going to be able to grow its total sales over the long term. After all, a larger revenue base is often key to driving sustainable long-term earnings growth for the company. And this has been actually the case. You see nicely how over the past 10 years, the company has been increasing its revenue. And in 2020, actually, they had a remarkable $45.8 billion in revenue, which kind of knocked it out of the park compared to the years prior to that. The last 12 months, the company is showing to have $53.7 billion in sales, which is the highest over the span of the past 10 years. Looking at return on equity and other key metrics, and ideally we would like to see a return on equity of above 25%. This is preferred for biotech companies. For the most part, and the chart is a little bit kind of awkward in the sense that because we have a negative 340% there, that's why the lines are kind of smooshed in a sense. But you look at that, like in 2020 the company had 188%, and in the last 12 months they're actually showing still 49%. They had 2 years in 2018 and 2019 whereby they had a negative, deep negative return on equity there. But other than that, every other year they were doing decent, very decent, actually above 25%, as we talked about. And we're also going to take a look at, lastly, the shares outstanding. Ideally, we'd like to see a company that has the share buybacks, and over time, they reduce the number of available outstanding shares in the market. For the last 12 months, we noticed that this has not been the case. In fact, the number of outstanding shares has increased. Over the last 12 months, the company is showing 1.78 billion as shares outstanding in the market. Not the biggest red flag, but something for us to be mindful about. We are going to take a look at the stock's performance over the past 1 year, as well as past 5 years. This is based on Google stock price and Google Finance data. You notice for the past 1 year, the stock had a return of 28.75%. This is purely based on the stock price and not taking into account the dividend payments. And the past 5 years, the stock is up by 88.45%, which is quite decent for this companies in terms of the stock price return. Lastly, we're going to take a look at a number of projections from a stock price and analyst estimations. What we are noticing here that based on TipRank's analysts, we have 12 analysts covering the stock. 10 of them have a buy rating and 2 of them have a hold rating, with the average price target for 1 year being at $128.33. If that holds true, that shows an upside of 18.18%, which is remarkable for 1 year return for this company. The highest price target is at $142 and the lowest is at $112 according to these analysts covering the stock on TipRanks. Next, we're going to take a look at analysts on Yahoo Finance, which is somewhat kind of aligned with the other analysts on TipRanks. The 1 year price target here is at $127.01. Lastly, we're going to take a look at the valuation metrics from Simply Wall Street and what is the intrinsic value of the stock, what's the fair valuation. According to analysts on Simply Wall Street, the fair valuation for the stock is at $268.84, suggesting that the stock is undervalued by close to 60%. There you have it. Before we move on to the second company for us to take a look at, the second fast grower dividend stock, I have a big favor to ask you. I've put a lot of time and effort to put this video together and based upon a lot of research, and I really appreciate if you can give this video a thumbs up and share it with someone who might benefit from the video as well. And of course, don't forget to subscribe to Moementum for more investing and financial freedom related videos for your reference. Thank you. All right, the second stock for us to review is a company called Smucker, with ticker symbol SJM, and it is a consumer staples company active in packaged foods and meats. Smucker was founded in 1897 when Jerome Monroe Smucker began selling apple butter from his horse-drawn wagon. Since then, the company has grown into a leading purveyor of consumer packaged goods found in most US households. The firm's portfolio is balanced across at-home coffee, such as Folgers and Dunkin', pet foods, nutrition and Milk-Bone, as well as consumer foods, mostly Jif peanut butter and its namesake jams. Almost all of Smucker's sales are made in the US to retail outlets, with a much smaller portion generated from restaurants and hotels. Overall, the company has a solid portfolio of well-known brands you likely can find in your home. And I can attest to that for sure. Many of these products I have already personally come across, tried, or bought, let's say, for our pets and whatnot. So I'm sure it's probably the same experience for you. It's always a good sign when you're dealing with a company that you are more familiar with, at least come across or use their products one way or another. Smucker has a dividend safety score of 96, which is considered to be very safe score. They do pay a dividend yielding 3.22%. As promised, it is a fast grower dividend paying company. In their last dividend growth in July of 2021, they grew their dividend by 10%. The company has $13.2 billion in market cap, making the large cap company. And look at the volatility. I just love it. It's only 0.13, considered to be very low volatility for the stock compared to the general stock market. Might be a great option for investors who do not want a ton of volatility when it comes to investing in a stock. Right, let us move on and we take a look at some key metrics in terms of, for example, dividend payout ratio. Smucker's payout ratio is currently at 43%, which is considered to be low for consumer staples, and that's a good sign. That means the company has a lot of room for continuing to grow its dividend. As you see, they've actually been fastly growing their dividends over the last 20 years with an average of 9% per year. Last 5 years, they've been growing it by an average of 6% per year. And in the latest increase, it was 10%, as I indicated earlier on. Their forward payout ratio is actually calculated as 46%. During the recession, the company's sales was up by 0.4%, which was above average growth during the 2007-2009. Their stock return was down by 27%, which was, again, although negative, was better than that of the S&P 500's negative 55% return during that time frame. And the company has been paying its dividend uninterrupted for the past 29 years, of which the past 19 years they have actually increased their dividend year after year. Their annual payout ratio for their stock is $3.96 per share, and the company does pay its dividend quarterly in the months of March, June, September, and December. Looking at valuation metrics for Smucker, their current dividend yield of 3.22% is about in line with their 5-year average of 3.01%, suggesting that stock may be reasonably valued today. Also, their forward price to earnings ratio of 14.3 is about in line with their own average of 13.9. The market, as a result, appears to be valuing the stock similarly to how it has in the past. You'd also look at the The numbers at the bottom, the price range for the stock, the lowest at $111.23 the past 1 year, and the highest was at $139.82. Looking at the number of key financial metrics, earnings per share, we would like to see this number growing steadily, nicely. For the most part, that has been the case. The only, I would say, downside you notice here in the last 12 months, the earnings per share is actually down by 10%. So a little bit of that red flag for us there. But historically, the company has been able to actually increase their earnings per share decently year after year. In terms of the total sales, overall, you'd see here, for the most part, there is a little bit of that cyclicality for sure. You see there are years that the total sales has gone down, then recovered. And again, we are seeing that in the last 12 months, $7.89 billion in sales, which is lower than that of 2021. In terms of return on equity, ideally, we would like to see above 15% for consumer staples. But for the most part, for the past 8 to 10 years, you notice here that for Smuckers, they had never actually hit that return on equity of above 15%, with the only exception being in 2018. And the last 12 months, they are showing to have a return on equity of 10%. In terms of outstanding shares, ideally, we would like to see this number declining, and we saw that happening since 2012 all the way until 2015. But in 2016, the company issued new shares, increasing its total outstanding shares to 120 million. But since then, they've continuously declined, and the last 12 months, they're showing only 111 million outstanding shares. Moving on, we're going to take a look at the stock price return. In the past 1 year, the stock is showing a 6.43% positive return. And in the past 5 years, the stock price is down by 6.78%. This does not take into account the dividend that the stock has paid. We're going to take a look at analyst estimates. The first one is from TipRanks, and we have 7 analysts covering the stock. 6 of them have a hold rating, and 1 of them have a sell rating for the stock. The price target based on average analyst estimates is at $128.71, and that shows an upside of 4.63%. Not the highest upside potential based on analyst estimates, but a modest one, not taking into account, again, the dividend that the stock is paying. Looking at analysts on the Yahoo Finance, here the 1 year price target is at $124.64, slight increase potential based on this estimation. And lastly, we're going to take a look at the stock price, the fair valuation for the stock price for Smuckers based on Simply Wall Street, suggesting the fair valuation being at $251.05 and the stock being undervalued by close to 52%. All right. Lastly, let us move on to the third company to review. It is another company in healthcare and biotechnology, similar to Appb that we covered first. It is another fast grower, Dividend, with 10% increase in their last increase in December of 2020. Amgen is the company we are looking at. It is traded on NASDAQ with ticker symbol AMGN. Amgen was founded by venture capitalists in 1980, and its scientists initially attempted to clone the light source for fireflies, grow chickens faster, and create organisms to extract oil from shale. You can see they tried different things, but eventually they settled on treating and curing disease, setting the foundation that would propel Amgen to become one of the world's leading biotechnology companies with more than 20 marketed medicines. Amgen's portfolio is reasonably balanced. Its 6 largest drugs account for around 60% of the firm's revenue, including a roughly 20% contribution from the rheumatoid arthritis treatment Enbrel, which launched in 1998, but as key patents lasting for the drug is still going on until 2029, giving the company some cushion to have that revenue from this drug continue to come for several more years. The company's diverse pipeline of medicines and financial capacity to make large acquisitions should help them to continue delivering moderate growth over time. Amgen does pay a dividend yielding 3.36% at this time, and their dividend score is at 74, considering to be a safe dividend payer. Company's market capitalization is $119 billion, making it a mega cap company, and the stock has a beta, a volatility score of 0.69, being under 1, suggesting that it's a low volatile stock compared to general stock market. Moving on, we're going to take a look at a number of key metrics from a dividend perspective. The company has a payout ratio of 41, again edging high for biotechs, and their forward payout ratio is similarly to that, is maintained at 41%. The performance during the recession, the sales for the company was down by 2.8%, again considered to be above average growth during that time frame, and the recession return for the stock was down by 19%. Although negative return, it was better than the S&P 500's return. And as we talked about the dividend growth history, even you can see for the last 5 years, the company has increased its dividend annually by 15%, considered to be very fast dividend grower in that sense. You're going to take a look at the payment schedules. You'd see here the company does pay its dividends on a quarterly basis in the months of March, June, September, and December. And currently, the annual payout is at $7.04. The company has been paying its dividend uninterrupted since 9 years ago. And each and every year since then, they have increased their dividend annually. Looking at the valuation metrics, Amgen's current dividend yield of 3.36% is 19% above its 5-year average of 2.84%, indicating that the stock may be undervalued, unless you believe that their company's outlook has weakened. Also, worth noticing that their forward price to earnings ratio of 12.2 is well below their own 5-year average of 13.9, as well as that of the healthcare sector of 19.6. So again, we want to take a look at a number of other financial metrics to just make sure that the investors have not necessarily turned pessimistic about the stock, or the stock prospect has not weakened. Looking at the 52-week price range, the stock price is actually hovering closer to its low range. The lowest price in the past 1 year was at $201.89, and the last trading price at the time of making this video was at $209.24, hovering closer to that, and the highest was at $259.14. It might be a good time as a result to consider potentially adding this stock to your watches, or even buying it based on your additional research. You're going to take a look at a number of other financial metrics to assess the strengths of the company. Earnings per share, look at that. A nice growth year after year, and look at the earnings per share growth at the bottom, by percentage wise, when you compare it. 22%, 17%, 14%, a nice growth. It seems that the growth is slowed down a little bit. For example, in the last 12 months, the earnings per share is up by only 3%, but the next 12 months is projected to be up by 6%. Still a nice return there for earnings per share. And if that holds true, the $17.20 return for earnings per share is the highest that the stock has had in the past 10 years, if that holds true. Outstanding shares, we would like to declining number, and that's exactly the case we're seeing. Compared to 10 years ago, the company is almost halved its number of outstanding shares, currently having a 583 million outstanding shares, and their total sales is nicely growing year over year, as you see here, for the most part. And the last 12 months is showing $25.5 billion in total sales, being the highest in the past 10 years, if that number comes true. Lastly, in terms of return on equity, we'd like to see above 25% for biotechs, and the company has knocked it out of the park for the most years, the only exceptions being close to 2011 and 2017, where it couldn't actually quite hit that number or come close to that. But the last 12 months, they're showing a return on equity of 61%, which is just remarkable. Now, we're going to also take a look at the stock price performance in the past 1 year. The stock is showing to be down by 7.89%, but in the past, as you see in the past 5 years, the stock is up by 44.12%. If you look at more closely at the graph for the 1 year, though, you'd see how the stock has actually started to decline quite heavily since early August or late July, and since then has actually come down so much so that it actually hit its 52-week low price in early October. So still kind of hovering around its lows of the past 1 year. Might be a good opportunity for investors with the long-term horizon to consider perhaps this company and stock. Looking at the analyst estimate, there are 10 analysts covering the stock on TipRanks. 3 of them have a buy rating, 6 of them have a hold rating, and 1 is a sell rating, giving an overall average hold rating. The price projection, average price target for the stock based on these analysts is at $235.88, showing an upside of 12.53%. Analysts on Yahoo Finance have a price target of $247.45 in 1 year. And lastly, looking at fair valuation for the stock, according to analysts on Simply Wall Street, the fair valuation for the stock is at $419.98, resulting in, according to these analysts, the stock being undervalued by about 50% plus. Well, there you have it, folks. A quick look at 3 high-quality, undervalued dividend stocks that are considered to be fast dividend growers, as you saw, 10% in the past 1 year and hovering around same numbers, or even in the span of the past 5 years, or some of them even showing in the past several years, making them ideal for you to consider to potentially add to your watch list, or perhaps do your additional research, and if you feel that's the right choice for you, potentially even consider buying the stock. But at the end of the day, we have done our extensive research, but it's so important as investors for you to do your own research and make sure that you're comfortable before you buy any stock that we talk about here on this channel, as well as any other stock for that matter on YouTube or any other sources that you read about. It's important that you do your own research and make that decision on your own. But if you found this video beneficial and hopefully guided you around some of the approaches, how we analyze dividend stocks and how we come about doing such research, we really appreciate it if you can give this video a thumbs up. It really means a lot to us and helps us to grow this channel and attract more like-minded individuals to pursue financial freedom. Here on Moementum Finance and Stock Investing channel, we post several videos every week talking about investing in the stock market, real estate, and alternative investment channels, as well as ways to reach financial freedom. So don't forget to subscribe for more such videos. Thank you, and we hope to see you next time.